Hello and welcome to NDTV Profit. You're watching Know Your Company, that's KYC. Today on our radar is a JBM Auto. Joining me is Puneet as well, who tracks the sector pretty closely. But let's first understand, Puneet, in terms of why a JBM Auto and what are the key questions we want answers to from the management. On number one, how this pure play EV bus maker is actually navigating demand in this scenario where competition is really high. On number two, the company is a pure beneficiary of government schemes like PM-E Bus Seva. So how are they even looking at servicing the private sector space from here on? Because concentration with the government is really high. And the competition which is increasing with legacy players now scaling up, how are they looking at navigating that aspect of maintaining their current market share, which is in that range of around 30 to 35%? And very lastly, what is the strategy going to be of the management to go ahead and reduce costs by insourcing components amongst others? Because right now, the major reliance is in terms of semiconductors as well as batteries, where there could be a concern. So these are the key questions that we want answers to from the management. But let's quickly understand what the company does. When you talk about JBM Auto, it's part of the JBM Group, a global conglomerate from India, operating into auto components and the equipment space. They offer EV charging infrastructure, e-mobility and battery, and they're committed to become net zero by 2040.
Well, the other one is aspects of JBM Auto is about the three key segments for the company, right? So let's put that across as well for this. Specifically, we have seen components division being one of the new ones, which is to watch out for in terms of margins as well. The other one is tool room division. Now, this includes the component side of the bit, and majority of the revenue for JBM Auto now comes from the OEM division. So that's about tool room. You have tools, dies, as well as molds for auto as well as non-auto sectors. Let's quickly look at the third key segment, which is the OEM division for the company. This is the main one because it designs, manufactures, supports buses, including the maintenance of the operations, which is something that the company has been doing as well. Let me quickly go across to the product line as well, which involves the EV business of the company. They have 9 platforms currently, which has 16 different variants of buses. This include luxury coaches, intercity buses, as well as tarmac buses, which are used at the airports for that use. We also have some staff and city school buses, and this is a segment that has started to grow now over the last 12 to 18 months because of the first time the demand coming back for schools as well. But Hiral, what about the EV aggregates part of the business?
In terms of EV aggregates, what they're doing is they're looking at advanced Li-ion batteries for EVs as well as the ESS and solar space. Secondly, what the features included are fast charging, long life, as well as waterproofing. So that's the major features that they're looking at when you talk about EV aggregation from here on. What's interesting is the product line, Puneet, right?
Yep, it includes, of course, the other auto components, and since it is an EV bus manufacturer, all these, including chassis, suspension, and safety system, is what the company is manufacturing currently. They also do some other part of the tooling operation, as well as connected solutions, as well as the charging infra, which is, of course, the 1,000 DC chargers which they are currently giving. And these are all connected solutions which lead to the actual sales as well. But talk to us about the business model as well.
An interesting business model because you're considering 4 aspects. One is the integrated e-mobility aspect, which actually focuses on components, EVs, batteries, charging, as well as the services that they provide. On number 2, you're talking about EMAS, which is a subscription-based mobility feature which they give. Secondly, they're looking at fleet management as well and digital fleet integration. Thirdly, when you talk about JBM E-Bus, this is mainly dealing into EVs, batteries, charging, and the digital fleet integration that we spoke about. And lastly, it's digitization in terms of their business model, where they are looking at AI, Industry 4.0, smart factories, and telematics. So that's in terms of the business model. But again, what's important is to look at how the revenue split works, Puneet.
Well, definitely. And, this is specifically for quarter 4. And in quarter 4, we do see a lot of sales of components, specifically for businesses that are built in. So we have seen components become the roughly 50% of the company's revenue. But the OEM division has been driving the growth momentum for the company. And that essentially is the main division for the company, which, of course, sells the whole bus together. The other two, like tool room, is a very small part. But the components business is driven by the sales of the OEMs. And hence, these two are some of the key ones to watch out for.
Yeah, and from a geographical perspective, domestic is majority 95%, 5% is exports. It's going to be interesting how they're able to meet the demand in the export markets as well from here on, and whether they're able to grow that share from export perspective, because your OEMs in India are now expanding from an export perspective. So that's going to be a key area to watch out for. But let's look at the big picture, Puneet.
Well, capital-intensive business, to say the least, Hiral. And they have been expanding capacity in this particular time frame. And although they have significant market share in the e-bus segment, we are now seeing competition come up. And we'll just talk about that in a little bit from the likes of Ashok Leyland, amongst others. Company's current market cap stays at 15,000 crores. And the growth strategy hinges on India's EV revolution going forward as well.
Right, so let's now quickly look at all the rating parameters that we are watching out for. Firstly, we'll have an income statement check, the balance sheet check, cash flow, return ratios. Moving on, shareholding, street credentials, outlook, and the valuation picture this time around is going to be a must when it comes to JBM Auto. So let's start, Puneet, with the income statement. How are you looking at it?
Well, the growth has been strong for the company over the last 3 to 4 years. From roughly about FY22, the company did about 3,000 crores of revenue. That increased subsequently to 5,400 crores. And what's interesting is also the margin profile. From roughly 10%, the company has navigated and gone up to 12% now in FY25, while profits as well have been growing at a slower pace compared to revenue. Revenue has grown at 20% CAGR, while profits have grown at 11%. But given the company's capital intensive nature, to say the least, we've given this a thumbs up currently, and that's largely because of the company's profile of growing the business steadily over the last 3 to 4 years. And we can see that in the company's quarterly performance as well, because when you see over the last 3 to 4 quarters, the margin trajectory, as mentioned, but in Q1 of FY25, the company had roughly about 1,140 crores in revenue. That subsequently increased by 10% to 1,254 crores in Q1 of FY26, which was just announced yesterday in terms of results. EBITDA as well, it has been a slight dip of about 8% on a YOY basis, and we'll speak to the management of what led to those factors, as well as something like the profits, which have actually grown from 34 crores to 39 crores on a year-on-year basis. So despite having a decent jump in profits on a YOY basis, we've seen the EBITDA going down a bit in this particular quarter, and that's led by some cost involvement as well. But when you look at the margin trajectory, and we put that picture out just right now, from 10.4% in FY22, steadily increasing to about almost 12% in FY25. This is just for the first quarter, and we'll see that in margin just be onwards and upwards from the 9.6% as well. But the balance sheet strength is the other one to talk about.
So yes, there is some bit of strength in terms of the balance sheet, and hence we are still giving it a neutral, because the concern is the sharp increase that we've seen in the debt to equity. That's the concerning area. If you talk about their equity base, that's remained absolutely stable over the last 3 years at around 24 odd crores. If you talk about their borrowings, they have been increasing. If you see from a 1,676 odd crores, it's gone up. So it's gone up as well to almost 2,600 odd crores. So there is a rise in the debt to equity, which is sharp. If you talk about the debt to EBITDA, that's almost around 3.9 times for a JBM Auto. So the question is about whether the company will be able to service its debt. And the debt turnover ratio is lower, which is indicating that the collection efficiencies is something which is not great. And that is what is impacting the cash flows as well. And you talk about the debtor days, that has also increased sharply. So the high debt from a fast EV or an OEM scale up is something which you should be looking at, which is a risk. And the working capital and cash flow strain on the e-bus orders is what you should be looking at.
Well, the other one's, cash flow aspect. And here as well, similar to balance sheet, we've given this neutral rating largely because of the slow progress on that aspect. Now, cash flow from operations were roughly about 484 crores in FY23. That subsequently fell in FY24. And while there has been some recovery it's still away from those levels. So that will be one key metric to watch out for. Cash flow from EBITDA, operational EBITDA as well, the CFO to EBITDA metric as we call it, that as well has come down below the 100% and it's almost down 50% from the FY23 levels. So that could be one of the key concerns because cash flow from operations to EBITDA, if that's above 100%, that's a key metric we look at. So we could see some impact there. The net cash flow position has improved, but it's not improving in line with the company's debt as well as the cash levels as well. So hence we've given this another neutral rating as well in this particular aspect.
And we have another neutral that's coming in for the other parameter, which is the return ratios. You know what's interesting is it's steady in that 12 to 14% kind of a band. But the question over here is, for an Indian company who's into this segment, is there a potential for a better ROC? Because you're usually looking at that range of around 60 to 20%. That's that range we should be looking at. 12 to 14% steady and hence a neutral rating there.
And, it's the shareholding largely, nothing too much to, complain here. A big thumbs up, 67.5% has been maintained over the last 3 to 4 years. We've seen the public ownership increase and being maintained at 30% in this particular time frame. So giving this a straight thumbs up of maintaining that positive momentum and confidence by the promoters in the business.
Right. In terms of the street credentials also, I mean, it's a neutral rating that we are looking at. Reason being is, there is degrowth on a YTD basis. The stock has underperformed around 15 to 17%. But if you have to look at the last 5 years, 17 times is the kind of returns investors have made as well. So long term, a good return. Short term seems to see pain.
Just finally, very quickly on outlook and valuations. Outlook, largely management has highlighted the battery manufacturing plant to help the insourcing. That will be a key benefit while increasing the capacity utilization to match up with the order book as well. Very quickly on valuations as well, Hirar.
Right, so that's with regards to where valuations are concerned. Outlook is what, you're looking at, where you're talking about battery manufacturing plant that will help sourcing is what they've said. And the capacity utilization is what is going to improve. And if you have to compare it in terms of valuations, as Puneet mentioned, we're looking at around 84 times on an Electra and a JBM, which is 74 times. So that's the trailing PE we should be looking at. But let's quickly just look at the final performance rating. If you check in terms of your income statement, it's a thumbs up. Balance sheet, cash flow, return ratios are a neutral. You're talking about shareholding, which is a thumbs up. Street credentials, outlook is a neutral, and valuation is a down. So the KYC rating that NDTV Profit has given a JBM Auto is a 5 on 8 so far. But now let's get in. Nishant Arya, Vice Chairman and Managing Director at JBM Auto. Nishant, morning and welcome to the show, and a pleasure to speak to you as always at NDTV Profit. Hiral Dadia here. My first question coming to you is, if you have to look at overall numbers as well and the way things are moving, what's the kind of outlook that you have from here on for FY26 and 27? Are you seeing similar kind of range, or do you think there will be some bit of outperformance?
No, because last few years we've been investing quite consistently in our technology, in our capacity, in creating new products. So I think this year from that perspective would be quite transformational. And already if you see in the Q1, we have really ensured that we have been focusing on about 14% plus EBITDA, and which is higher than the previous quarter and on YOY basis as well. At the same time, we are enhancing the asset utilization because having a very good order book, a lot of deliveries are going to happen in this year. So definitely the top line would increase substantially. Plus, we are seeing very good traction from a lot of our private customers. And we have come up with our electric coaches. And electric coaches and electric intercity is gaining a lot of interest in the market. And we are delivering those buses as well. So a combination of all these things. And we have launched our new generation batteries. So the new generation batteries are receiving a very good promising interest from the market. So we're getting an edge on that as well.
So Nishant, my question over here is, you said, yes, private orders you are looking at, but your majority concentration is in terms of government orders. That's number one. Two, taking that large order book that you already have in place, Delayed execution has led to working capital and receivables which are piling up for the company, which is evident from the balance sheet. How are you expected to maneuver that risk from here on?
No, so what is happening is that we have been one of the very few companies which has been able to address the rare earth magnet challenge, because we were seeing that is something which could come up, and we created strategic inventory. So that is why you would see that in the upcoming 2 quarters also we would not have any impact basis that because of the strategic inventory which we created. Parallelly, we have tried to ensure that we have very resilient supply chains across the world with our global suppliers. So, basis that this has taken place, and now with enhanced deliveries, even with the little sluggish market in the automotive sector currently, we have jumped up by more than 36% in our top line on the EV side of it. So clearly, the market and the company is moving in the right direction, given the kind of execution of different orders we have.
Nishant, a very good morning to you, and thanks so much for joining in. It's Puneet this side. Largely, Q1 is generally a slightly weaker quarter in terms of just starting off this year as well. So for this year, do you anticipate both the growth metrics to continue, which started late last year? Because in this year, we have seen commentary coming from other EV bus makers as well. In terms of growth, opportunity has been strong. So do you see that you will be participating more in terms of tenders, or do you think that this year will largely be the consumption of the order book, as you mentioned?
No, so definitely we will keep participating in tenders which we see as strategic opportunities, and we will focus on execution, because as you see that all such projects have 1.5 to 2 years of gestation period for its turnaround to happen. Given the kind of infrastructure requirements in the bus depots, the contractual engagements and agreements to be in place, and everything else to be executed based on the routes and the complete planning which every city has to undergo. So I think that is something which we are focusing on a constant basis now. Yeah.
And Mr. Arya, just in terms of what's the company's strategy for participating in tenders? Are you looking to maintain the buses for the next 10 to 12 years, or similar to the other players' strategy, do you just want to sell the bus outright and not maintain it for this particular time frame?
No, so we are doing a combination of both because we have received a lot of support. As you see, we are amongst the only companies in the country to have Asian Development Bank and AIIB, global MFIs who are supporting us, and now we will be inking few other big partnerships which will be ensuring the growth, and also a lot of deleveraging will also happen in this year, which will ensure that the company is getting more and more healthier, and we are on track for that.
Right. Nishant, if I have to look at the debt to EBITDA is pretty much high at around 3.9 times. The debt turnover ratio is low, which is indicating collection efficiencies, which is impacting cash flows. But if I have to look at the overall cash flow as well, slight improvement that has come in from what it was in the last 2 years to FY25. What's the plan with regards to debt servicing? Are things changing? How are you looking at that aspect?
No, so in this year, definitely, as I said, we'd be reducing our debt. And as the company would start generating a lot more positive cash flows in this year, that would also enhance the capacity for further growth and enhance the profitability as well.
And how much are you looking at that number to be in terms of positive cash flow?
No, so we are trying to see that definitely about 20% more than last year as a bare minimum. And we would be trying to see that close to 100% of ops to EBITDA is what we want to see in by the end of this year, or let's say first half of next financial year.
Mr. Arya, just a couple of questions. In terms of battery insourcing, what's the current ramp up of that facility of ramping up battery production? And separately, how much are you currently utilizing in your own manufacturing of EV buses? How much is currently insourced from your own battery plant?
No, so 100% of our batteries are insourced. and our current capacity has been enhanced to 6 gigawatt, and which has just happened at the end of last financial year. And recently, we have also seen a huge order book which has been created from the energy storage business, because our battery facility is well equipped for catering to different segments within automotive, whether it's buses or other segments. And now we are going to utilize it for energy storage applications as well. So
But
the utilization would be going up significantly in this year.
and how much would that out of the 6 gigawatt? I'm guessing not all of it will be constructed right now, right? So what is the operational battery gigawatt capacity, and what's the utilization? Is
That's
it
the
around 20?
operational capacity, Puneet. Yeah.
So is the utilization over 30%, or is it hovering around that number right now?
So this year, what we are targeting is we should have about one-third capacity utilization. Yes.
Okay. Nishant, how are you looking at the export side of the business? It's still 6% of your revenues. Though you have the India-UK FTA, which could probably help the company from here on. I know you had said that you would be looking at UK opportunities only from FY27. So what is that angle? How much? And do you see any barriers on that end?
I think since the FTA has just been inked in the last couple of months and further details have just been rolled out, we would be looking forward to understand more in detail and then really make a plan. And that's the reason I had mentioned that things will fructify and actions would start rolling in from the next financial year. And we will be using this financial year to really develop our strategy and make inroads into those markets there
Nothing as
for our products. Yeah.
Okay, so nothing as of now. So when you're talking about inroads as well, you have mentioned about 4 new products that you would be looking at. Any details on that that you could give our viewers? And secondly, if you have to talk about inorganic growth opportunities, anything that is on the anvil that could be signed in the next 3 to 6 months?
Nothing concrete as of now. The products, if I talk about, we are quite focused on our global electric coach, which is called Galaxy, and that has been very well received by our global customers. And that was launched recently also in Germany and European market. Plus, we are seeing great traction for the city buses, and there is a clear opportunity which lies for a lot of customized solutions in the intercity category, in staff category, and tarmac category for the European market. Yes.
Mr. Arya, just one on capacity as well for the buses. You have roughly about 20,000 that you can manufacture annually. Just looking at the number from Vahan specifically that got actually registered was just under 1,000. So if you can just give us some clarification on registrations of those buses and the order book execution. Is it largely over the next 2 to 3 years that you want to, your order book of about 5,000 buses, and you can give that number as well. So in terms of current capacity at 20,000, the actual Vahan and registrations, and in terms of execution over the next 2 to 3 years, how will that turn up in terms of your order book execution?
So our current order book, which we had shared also beginning of this year, was about 11,000 buses, out of which we have executed in the last year and first quarter of this year. So currently our order book is at about 8,500 to 9,000 buses, which is available to us. And we had also supplied a lot of buses to Telangana state, in addition to Delhi, Gujarat, and other places. So Telangana state is not covered under the Vahan data for some reason. And there are about 500 odd buses which have been supplied in the last few months are not a part of that. But that is a part of our revenues and deliveries. And
Nishant, a quick
similarly,
interruption here. Out of this 11,000, what percentage is government and what percentage is private? Because private does mention that they do face challenges accessing a JBM Auto because your concentration is government.
no, so our split if out of 11,000 is approximately 70-30. So we have 30% private sector and about 70% on the government side currently. Yeah.
Got it. I think lots that we need to watch out for. 11,000 order book split between government and private in that 70 to 30 range as well. But thank you, Nishant, so much for joining us on the show on Know Your Company at NDTV Profit. Thank you from Puneet, the team that put the show together, and myself. In fact, lots more lined up on the other side. Please stay tuned to NDTV Profit.